Hey everyone, so we're going to go through moving averages today, and I want to go through 3 really simple strategies that you can use using this indicator on any asset, on any time frame, and actually use any moving average to make really simple, easy, profitable money when you are buying and selling, so that you can identify trends and make money using this indicator. So if that sounds like something that is going to be interesting and useful to you, go ahead, drop me a like down below, subscribe to the channel for more trading and investing content, in particular on crypto. And without further ado, let's crack on. Before we get into any of the strategies, we want to know what the differences are between the different moving averages and how to get them up on our screen. So first thing we're going to do is we're going to go onto indicators at the top on TradingView. We're going to type in moving average, okay? And you can see that we have the 2 options that we want, which is the first one, moving average, and then we have moving average exponential. So you can hit those and they will appear on the left-hand side of your screen on TradingView. And once you have them up on TradingView, okay, if you hit the little settings tab, just when you hover your mouse over them, okay, you can see that we have the length, which is the most important thing, and then you can adjust the style as to how you want that to appear on your screen with the different colors and how thick you want the lines to be shown, okay. But the most important thing is going to be the inputs, and that's basically going to tell you, it's currently set to 9, okay, by default, but if we set that to 50, okay, and we just get that to show, okay, this is a simple moving average of the last 50 candles on whatever time frame you are looking at. So at the minute we're on the 1-day time frame, so one candle represents 1 day's worth of price action, and this price at the minute with where the simple moving average is, okay, so we've typed in 50, is at about 35,000 on Bitcoin, just using that as an example. So that basically means that the average price of the last 50 days, okay, is $35,000, okay, and we can obviously change this. We can go 200 and we'd get an average of the last 200 days, and the same thing for the moving average exponential. And the difference between the two, okay, is that the moving average exponential basically shows you price action that is more weighted to more recent price action, so it gives you a slightly different moving average. It's the one that I prefer to use. Or if you have the simple moving average, it is basically a flat average of the last 50 candles or 100 candles, whatever the length is that you've set, okay? And that's basically the main difference between the two. Now, you can use any moving average that you like, okay? But my personal preference, okay, is I typically use the 50-day, the 100, and the 200 on any given time frame, and it does depend on the different asset class, but those are the 2 that I'd usually set. And when I use the exponential moving average, I do tend to prefer using the Fibonacci numbers sequence in the moving averages, okay? And what I do there is if I just type in Fib EMA, you will get this one over here, which I've starred in. It says Fibonacci EMAs 8, 13, 21, and 55. And this is basically going to be the start of our strategy over here. And this way, the EMAs and the colors are already set for you, okay? And you can see that really clearly over here. And now you basically have the different moving averages that you can use, and you can use simple, you can use EMAs, or what I use is Fibonacci EMA ribbons, okay? And this is basically going to be the foundation for using moving averages. So now we have our moving averages on our screen. We know how to get them up and exactly what they are showing us, okay? I do want to mention that these are a lagging indicator, which typically means that I will use this in accordance and in confluence with other indicators such as RSI, horizontal support resistance, volume, order blocks, different things like this, in order for me to you know, enter and exit positions. So I would say don't solely rely on moving averages, but when you see some of these strategies that I'm going to show you, I think you'll find these really neat and really simple and easy to use. So let's get straight into it. So the first strategy that we are going to go over is the Fibonacci EMA crossover signal, and what this is going to do is going to give you a really clear indication of where the trend is going, and when we exit and enter trades, we are going to be on average profitable, because you want to play like house in a casino where you put the probabilities in your favor. And we're going to go through Bitcoin, but this works on any chart, any time frame, any asset class. I'm going to go through some of these examples on a different chart as well. So If we just get up our Fib EMA over here, and you can see that we have these different colors. Now the orange is the 55 exponential moving average, and all the other colors are shorter time frame moving averages. And what we want to do is whenever we get a crossover of all the shorter time frame moving averages, okay, going over the orange line, which is the slower moving average, okay, then we are basically going to enter and exit positions. And you can see that you can use this in two different ways to make money. So let's just take this, for example, on Bitcoin, where we got a crossover on May the 13th, 2021. So if you entered a short position just over here where I've marked out, okay, or you sold your Bitcoin over here, okay, and then you re-entered when it crossed back over, okay, you can see that you would have saved yourself a lot of money, or if you were shorting the market, then essentially you'd have saved yourself 35%, okay. So that is basically how we want to do it. And then again, if you were to have entered over here for a long position, okay, and you bought, and then you go over here, and then you get this crossover here, which isn't exactly the most clear, okay, but you do get a crossover, you're looking to be objective with your strategy, then again, you would have made yourself a nice 22-25% on Bitcoin, okay. And the same thing goes over here. If you entered here and you got the crossover over here, you basically enter here, and then you exit over here, and the same thing, you rinse repeat. You can see again, it's a very consistent and profitable strategy. If you go short over here, where would you have exited when you get that crossover back to the upside just over here? So again, you've negated that downside action, and essentially you're able to take a chunk of the pie. And it is important to remember that you are looking to take a chunk of the pie, not looking to get the absolute tops and the absolute bottoms, okay. So you just want to make sure that you are having a strategy that is basically profitable and consistent in your favor, okay. And if we just go back in time, you can see that, so as to make sure that I'm not cherry picking this, okay. If I just clean up the chart over here, is that any time, again, just over here, if we use the March 2020 COVID low, we got a crossover over here. So you basically exited the market or shorted over here. We entered over here, and then essentially you've saved yourself some downside action and made some profit over here. And actually some of these techniques, when used correctly, just like that we got in April 2020 after the COVID crash, is that if you hadn't got a signal to exit the market, look at the massive profits that you would have made, okay, because the next time that we got a crossover over here was actually in May 2021, and that was a massive upside potential of 600% on Bitcoin. So that just goes to show how powerful that is. And if we just drop this down to like a 4-hour time frame, for example, I'm not going to cherry pick anything. I'm just going to pick out any trend that we've got over here, and let's just say we take this from the high that we got on November 21. This is on the 4-hour time frame. We would go short over here. We would basically get this crossover over here potentially, and then we could either go long or re-short. And again, look, we are getting the crossover, we're going here, we're not looking to get the absolute bottom, and then we basically take the crossover again when it goes, and then we rinse repeat. And the same thing for uptrends. You can see that back in May 2021, when we got a 4-hour crossover just over here, okay, we didn't get that crossover back to the downside until just right at this Fibonacci crossover at $50,000. So you can see again that you've made massive profit over here. It's really important to stay objective with these strategies, and not try to tinker with them too much. And if we have a look again at the S&P 500 and how that works, you can see that if we just use this as an example, we take this on the daily chart, okay, what do you see? Let's just go over here. Okay, is that whenever we got a crossover here to the downside, okay, we haven't yet got a crossover, so we would basically be staying in this trade until we get a crossover, and then we'd basically look to take profits on a short position. And then same thing that we got on the up leg cycle from COVID, just to use that as an example, we got a crossover over here. We didn't have to exit that position until we got a crossover back to the downside over here back in October 2021. So you can see how powerful this is, and we'll just use one more example. Let's just take oil, which is quite nice. Okay, and then you can see that if we use the COVID 2020 crash as a nice little entry point over here, we entered here, and then we potentially exited or entered here again, whichever way you look at it. Okay, we made profit on this leg, and if you entered back in on oil in November 2020, when did you get that next crossover? You got it back over here in August 2021, and you rinse, repeat, you'd have entered. You could have taken profits over here and maybe even potentially entered long again, and then again that next time to take profits would have been on this crossover. So you're looking at those main crossovers, and it's not going to be profitable every single time because there is nothing that is foolproof. Sometimes it's going to be a little bit harder to see, but also the way that I would be playing this if you're taking any potential trades is that, let's say for example you entered on oil on January the 6th on 2022 when you got this crossover. This is where you'd use horizontal support resistance to give you some mitigation of risk. Is I'd be putting my stop losses somewhere at about $66 or about $62 per barrel, having entered at $75. Or I would also do whatever happens first, which is basically if we get a crossover back to the downside and you are in a loss. So let's say you were, like I said, to enter at $75. I would do whichever happens first, which would be the either take out this swing low that we have to the left of us, okay? Or if we were to have got a crossover to the downside and we basically, you know, move down, if this happens first, I would put my stop loss over here, and this way you're not going to lose too much, because like I said, you always want to make sure that you have risk management in place when you are using any strategy. So that's how I would use the crossover technique on Fibonacci moving averages. As we're about halfway through the video, don't forget to like the video and subscribe to the channel. Not only is it helpful and useful for me, but it's massively beneficial for you because you get to keep up to date with learning new strategies and new techniques to stay ahead of the market and give you that edge in trading and investing. So without further ado, let's crack on. The second way that we can use moving averages is to identify trends and knowing when to join them in areas of value. So what I mean by that is that you know, we can use the 50, the 200, the 100 day, any sort of moving average, but we want to make sure that they are showing us areas historically where we have seen reactions from in the past. So if we just use Bitcoin for an example, and we look at this on the weekly chart, okay, what we can see is if we use the 200-day moving average, okay, you can see, this is why we've been speaking about this on the channel for quite a long time, is that any time we move down towards this key moving average, is that we've had reactions from here in the past, okay, and sometimes we puncture through it and come back up, okay, but you can see that whenever we reach this, then it's typically provided a historical really good buying opportunity to join the overall macro uptrend that we've been in, okay, and you can see that really nicely here on Bitcoin. And you can use this, like I said, with any sort of time frame. So you can see that, again, in the same way that I said to you, if you're entering or exiting trades, look left to see where to potentially put that stop loss. So for Bitcoin, if you entered over here, you could put your stop loss at about, you know, $3,000, and you'd have been correct on that point. And over here again, if you entered on this touch of the 200-day moving average in August 2015, then you could have put your stop loss here and you'd have been pretty safe, but at least that saves you against some downside action. And if we use a different moving average, and let's say we use the exponential 21 moving average, for example, this is where you can use it on any time frame. You can see that you want to use the right moving average for the right time frame and to show you the right direction of the trend, where if we have a look at Bitcoin, let's say in the last bull market, is that whenever we reach that weekly 21, you can see that we got support. So every time that you come down and touch this weekly 21 moving average, okay, you can see that we basically moved up and just kept on bouncing off this line. So that's where it gives you areas of value to go into. And when you use this in confluence, like I said, with other indicators, then it can be super, super powerful. So for example, let's just take a look at this example on Bitcoin. You can see that over here in September 2017, we got this touch, but it's also a horizontal support resistance area, okay? And same thing for some of these areas. It's not always gonna be so clear, but you can see that when you start to piece together 2 or 3 different reasons, ideas that you should be joining and entering a trade, it can be really powerful. And you can see that it's exactly the same on the way back down, is that once we basically break down below it, we test these key areas, which is this blue exponential weekly 21 moving average, and we basically keep bouncing our way down until we don't, okay? And it's not always going to be, you know, clear cut and simple, because you can see that over here back in 2019, 2020, we chopped around for quite a little while, but you can see that when you get it right and when you get the big decisions right, they can be really impactful and powerful. And at the minute in this bear market, you can see that we're doing this over here, retesting that weekly 21 moving average. So this would be a potential area to basically be taking any short positions or selling profits. That's what people would be using it for. So, you know, that's how we want to be using that for areas of value. And if we look at, you know, the S&P 500, you can see that during the uptrend in COVID, anytime again that we got at that 21 moving average, okay, somewhere close to that, we ended up bouncing and you were able to take profit, and you can actually put in quite a good you know, mitigation and risk strategy, where if you were to buy somewhere down here, look left at the next swing low, okay, and put your stop loss down there. That's how I would do it. And you can see, similar to Bitcoin, we are now doing the reverse over here, but you can see how they can be quite powerful. But it is important to note that using this strategy is going to be useful on some indicators, on some moving average indicators, and some are not. So let's say we get the I don't know, let's just try to get up the 50 moving average, okay, like the 50-day, okay, and you might find, oops, I think that's the 50-day. You can see that sometimes it's going to be really useful, okay, like in this area, where we basically, every time we got to that 50-day moving average, we were able to bounce up and down. But there are going to be areas where things are going to be a little bit choppy and not so clear. So this is why, you know, in areas like this as well, why you need to use confluence with other indicators, okay, to give you you know, that directional bias and that extra confidence when you are looking to enter and exit trades using moving averages. The third and final way to use moving averages is perhaps my favorite and also the most simple to use, and that is buying and selling when you move deviations above or below that particular moving average. So what I mean by that is, let's say we take Bitcoin as an example and we use the 200-day moving average. What we can see from historical past performance is that, let's just use this as an example, and whenever we have moved 50%, for example, from our 200-day moving average, it's typically provided an incredibly good buying opportunity for Bitcoin. Okay, and you can see this, that this always works and puts, again, the probabilities in your favor. And you can do this with the 4-hour chart, and it might be like a 30 or 25% deviation. I'm just using this as an example, okay? And, you know, usually the more extreme you get from a particular moving average, usually, just like an elastic band, it tends to revert back to the mean, okay? So the same thing is also true on the upside. So if we take these major peaks and we can see that we deviate 200% above it, again over here about 130% above it, over here again about 162% above it, okay, and so forth and so forth. You can see here that, you know, that is going to tell us that whenever we are overstretched above a particular moving average, and in this case Bitcoin, we can assume that if we are currently holding any positions that are 100% above that 200-day moving average, or 150% or 200%, we know that it's probably, on the balance of probabilities, a really good time to be taking profits. And that's how you want to be using these in order to basically put the probabilities in your favor. And remember, you're not going to get the exact tops or the exact bottoms every time, but you damn well know that this is going to give you that edge in the market, and it's the edge in the market that really cuts you above from all the other traders and all the other regular people in the market. So if you got some value from this video, like the video, subscribe to the channel, and make sure that you hit the bell icon as well to keep up to date with all my trading and investing cryptocurrency videos. And also let me know down below in the comment section how you have found this strategy for yourself, and show me the results as well down below. I'd be really interested and keen to see that. So hopefully this has helped you out. Have a great day, and I will catch you in the next video.